Hello, welcome all. So this side Abhilash. So in this session we are going to cover Unit 5 Efficient Market Theory. So in the efficient market theory we have to cover weak from efficiency, semi-strong from efficiency and strong for efficiency. So after learning these three theories we will understand the measuring methods of risks and return of securities. Securities mean the stocks, shares. Okay. So let's start with the introduction of efficient market theory. An efficient capital market is a market that is efficient in processing information. In the other words, the market quickly and correctly adjusts to new information. In an information of efficient market, the prices of securities observed at any time are based on correct evaluation of all information available at that time. Therefore, in an efficient market, prices immediately and fully reflect available information. So it is the market quickly and correctly adjusts to new information as per the efficient market theory. The definition of the efficient market theory: in an efficient market, competition among the many intelligent participants leads to a situation where at any point in time actual prices of individual securities already reflect the effects of the information based on the events that have already occurred and on events which as of now the market expects to take place in the future. In other words, in an efficient market, at any point in time the actual price of security will be good estimate of its intrinsic value as per the Professor Eugene Fama. So the efficient market hypothesis is made up of three progressively stronger forms. One is a weak form, the second one is a semi form, and third is a semi strong form. So we have three theories, three efficiencies: weak form efficiency, strong, semi strong, and the strong efficiency. Right. So let's start with the weak form efficiency. So before starting the weak form efficiency, so this is the efficient market hypothesis graphs. So all historical prices and returns are here. Okay, these circles. So you can see the all information, public private information is in strong form. All public information is in semi-strong form, and in the weak form we have all historical prices and returns. Okay, in this diagram the circles represent the amount of information that each form of the EMH includes. Note that note that the weak form covers the least amount of information and the strong form covers all information. So that means note that the weak form covers the least amount of information, the strong form covers all information. So as per the this graphics you can see the weak form is just containing the all historical prices and return. It is not talking about the current situation, it is not talking about the current prices or future, right? But if you see the strong form, this circle, right, that this is third circle, it is having all information public and private, right? So the weak form covers the least amount of information. Why least? Because it is just covering the historical price and return, and the strong farm efficiency is having all information, right? Also note that each successive farm includes the previous ones, right? Whatever farm the information is having in the weak farm, that will be semi-strong, and the whatever information is stored in the semi-strong, that will be available on the strong farm, right? So note that each successive farm includes the previous ones. Hope you understand. So let's move to the weak form efficiency. So the weak form of the efficient market hypothesis says that past prices, volume, other market statistics provides no information that can be used to predict future prices. If stock price changes are random, then past price cannot be used to forecast future prices. If the stock prices changes are random, then past prices cannot be used to forecast future prices. That means the stock price, the changes are random, right? It is not constant. Then past prices will that will not help you to forecast future prices. You can't predict. So price changes should be random because it is information that drives these changes and the information arrives randomly, right? Price should change very quickly and to the correct level when new information arrives. So to see next slide, let me check what is the so the next slide is talking about the semi-strong that we will cover later. So now just focus on the weak form efficiency. So price should change very quickly and to the correct level with new information arrives, right? Whenever new information, new positive information arrives about any stock, any security, the price will move quickly in any direction, right? This form of efficient market hypothesis, if correct, repudiates technical analysis. More search report on the notion that the markets are weak from efficient. So weak from efficiency claims that past price movements, volume, earning data do not affect a stock price, can't be used to predict its future direction, its future price. Weak from efficiency is one of the three different degrees of efficient market hypothesis. Weak from efficiency, also known as the random walk theory, states that future securities prices are random and not influenced by past events. Advocates of weak form efficiency believes all current information is reflected in stock prices and past information has no relationship with the current market prices. That's why the investor, the trader can't derive the future price of the stock. He can't forecast the future price of the stock. The concept of weak form efficiency was pioneered by Princeton University economics professor Burton G. Malkin in his book A Random Walk Down Wall Street. So he has written his book in the 1973. Okay. The uses of work from efficiency. The key principle of weak from efficiency is that the randomness of stock prices makes it impossible to find price pattern and take advantage of price movements. Especially, daily stock price fluctuations are entirely independent of each other. It assumes that the price movement does not exist. Additionally, past earning growth does not predict current or future earning growth. Weak propositions do not consider technical analysis to be accurate and asserts that even fundamental analysis at times can be flawed. It is therefore extremely difficult, according to weak form efficiency, to outperform the market, especially in the short term. For example, if a person agrees with this type of efficiency, they believe that there is no point in having a financial advisor or an active portfolio manager. Instead, investors who advocate weak form efficiency assume they can randomly pick an investment that will provide similar returns. Okay, so rest to form efficiencies we will cover in the next session. So we are stopping here. Thank you. Best wishes.